Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities. And as always, I am joined by my partner, CFA, all things Fed, rates, and liquidity, Gregory Faranello. Good morning, Greg.
Good morning, Michael.
Morning to you, sir. And we have a special guest today, Jim Bianco from Bianco Research. And Jim, we really thank you for taking some time on such a busy day today.
It's a pleasure, guys. Look forward to the conversation.
Listen, guys, I always say this, Greg, we've been doing this quite a long time. There's certain days when I should probably be quiet and let the experts get after it. So I'm going to stay out of the way most of the time today and let you guys get into, some really important things going on here today.
All right. I appreciate that, Mike. And Jim, it's great to have you. Thank you for joining us. And in tradition we've been doing this now for 3 years. We like to dive right into it. So, I'd like to start off first, if you don't mind. We'll stay away from the bigger picture. Heading into this week, obviously extremely dynamic, 48 hours. What your thoughts are in terms of the meeting itself, the decision in terms of the rate decision, the summary of economic projections, and then some thoughts on Jay Powell's presser.
Let me start by quoting you some odds from the marketplace. Before Friday's CPI report, the marketplace was pricing a 4% chance that the Fed would raise rates 75 basis points. Earlier this morning, it was pricing a 43% chance that they would raise 75, and it's right now at around 33% as we're recording. So all of a sudden, 75 basis points is in play, and there's three shops, Nomura, Barclays, and Jefferies, that are calling for the Fed to hike 75 basis points on Wednesday. Now, that would be a big departure for the Fed to do that, because the Fed likes to do this thing called forward guidance. And that's a fancy word for, let me tell you 13 times that I'm going to do something before I do it. And they haven't told us 13 times that they're going to raise rate 75 at this meeting. So the Fed is in a bit of a quandary, because it seems like the market wants the Fed to get really aggressive right now. If you're going to raise rates 100 basis points, 50 at the next two meetings, just go 100 today and be done with it, or 100 on Wednesday and be done with it. But I don't know if the Fed's quite there just yet. And so as we go into this meeting, that's going to be the first thing. Do they go 50 or 75? Well, until 8:30 Eastern on Friday, the answer was there was no discussion. They weren't going to do that. But now there is a chance that they might wind up going 75 basis points. So everything is up in the air. And looking beyond that meeting, I think that the Fed is going to have to lay out an aggressive stance, because that seems to be what the market wants. And the Fed's not delivering it right now. I think more timid Fed would mean worse markets. A more aggressive Fed would mean probably more stabilization in markets. So they've got to get more aggressive in order to try and stabilize markets, if that's what they want. And I think it is. So we'll find out, even if they don't go 75, the next question is, does he lay out that for the July meeting?
No, that's a great point. I mean, if you look at, I guess, over the next three meetings, we wake up this morning, we have 175 basis points priced in now through September. So yeah, certainly, I think the market is looking for the Fed to become more aggressive here. We speak about inflation. You talk about the CPI print. It really all emanated from that. You've had, I think, one of the best calls on inflation in the marketplace. And I've watched you on a couple of segments where you've been challenged in terms of where your conviction has been. And you have really been steadfast in terms of inflation. Can you talk to us a little bit about, what we saw on Friday and how you see the evolution of inflation going forward? And at the same time, we are seeing growth slow. So how you see that play out in terms of, how the Fed is going to look at it?
I think it's important to understand that what's happened in the marketplace or in the economy is something we haven't seen in 4 decades. We have real serious and persistent inflation. Going into Friday's meeting, one of the things I'd been arguing about last week is there was a strong contingent of market participants that did not believe that inflation was an issue. They still believed it was transitory. And let me give you a definition of transitory as it has evolved, because it constantly evolves. The current definition of transitory is do nothing about inflation. Just sit there and wait. It will peak on its own and it will go away by itself. There is no need to have policy lean on inflation one way or the other. I've been estimating, as I did before the CPI report, that maybe a third to 40% of the crowd of the Wall Street professional management community still believe that on Friday. And then when the CPI report came in at 1% above the highest estimate, 8.6%, a new 40-year high, and the lesser talked about statistic that I think is very important, CPI is already up 4.1% this year. So this whole idea that we're going to finish the year with a 5 or 6% on CPI, we're going to have 5% CPI next month. We're going to already have 5% done next month, and we'll have 6 more months for it to continue to grow from there. I think that was a watershed event. And I think what we're seeing in markets is that 40% of those that still believed that inflation was transitory finally gave it up. And they're now capitulating to the inflation is more persistent crowd. Now, why is inflation more persistent? I think why has inflation been low for the last 40 years? It comes to 3 letters, DGT, demographics, globalization, and technology. Let me take them backwards. On the technology standpoint, we've all know about the Amazon effect and the internet effect and its ability to squash down prices. I would argue that's already played out. We already have Amazon. We already have the internet. You can't create another Amazon. You can't create another internet. So all of the impact of lowering inflation has been done from technology. Globalization, we're all in the understanding of the world that we are now probably in a deglobalization world. We're in a just-in-case inventory cycle as opposed to a just-in-time inventory cycle. And that's going to create more frictions on prices and keep them up. And as far as demographics go, I'm going to give you a little different answer on demographics. Every pandemic throughout human history has led to a sea change in human activity. This one is no different. What is that sea change it's led to? We know it as remote work from home. I think that is a thing. It is a permanent thing, and it's going to grow. Only 8% of the offices in the island of Manhattan, in a recent survey last month, are full-time, 5 days a week, 8%. The rest of them are some version of hybrid or fully remote work. That changes your lifestyle. That changes my lifestyle when you work from home. The biggest thing you wind up doing is you wind up consuming more stuff and less services. And that's why we have this chronic supply chain shortage and we have this chronic inflation with stuff. How do you fix that? Recognize work from home is a permanent thing. Recognize trillions of dollars needs to be spent to completely restructure the supply chain and the stuff that we buy. Look at what's happened to the retailers, Walmart and Target. They ordered the wrong stuff. And now they're stuck with these bloated inventories and their stocks have been getting killed because they don't quite understand the 2022 consumer. 2019 is not coming back. We are in a new normal, to use a Muhammad Al-Arian term. That doesn't mean it's bad. In fact, I'd argue it's actually pretty good. People don't want to get on the smelly N or Q train in Manhattan or take the New Jersey Transit. I've done that. You've probably done that. And that's a redefinition of humanity when you've done that at times. They don't want to do that anymore. They want to go on to something else to give them more freedom and more flexibility. So that is not necessarily a bad thing, but lots of things have to change because of that. While they change, when you combine that with technology and deglobalization, I think there's going to be a friction that we're in a period of many years of much higher inflation. And it's going to take a while for it to go away, which means we're going to probably be in a secular bear market in bonds as interest rates go up. And it's going to lean on all risk assets as we move forward from here, if nothing else, from lower multiples and maybe margins, profit margins get squeezed because all of a sudden your cost basis is not going to be as sure a thing as it was pre-pandemic.
Yeah, no, that's fantastic. I've caught a few of your posts on LinkedIn with regard to the remote and work from home. And I appreciate your conviction. You know, the globalization aspect of how we're changing literally in front of our eyes. I mean, you and I have been in the marketplace, I think, around the same time. So we've seen that evolution. But I'll follow up on that then with regard to, so when you look at the Fed, you look at interest rates, you look at what the market's pricing now, we start to think about the terminal rate, which they've obviously been pushing out here too. And we have the balance sheet on top of that. How do you see, so if this plays out over the course of 1, 2, 3 years, how do you see that terminal rate playing out over time? And what impact do you think over time the runoff of the balance sheet will have?
So let's give some definitions. The terminal rate is basically what rate is the Fed going to stop raising rates? Probably sometime in 2023. Memorial weekend, that was around 3.25% is where the market was expecting it to be. Today, that's nearly 4%. In just the last 2.5 weeks, it's moved up that much. The last Fed dot chart we got on the terminal rate, where the Fed gives their guess, was back in March. Now, that was way back a long time ago, and they were at 2.5%. Now that's going to move up, but how much is it going to move up? So what the market is trying to tell us is there's a whole lot more rate hikes coming, and there's a whole lot more of a parallel shift of all interest rates from overnight money to the 30-year going much higher. Now there's an old adage in the market that when the Fed starts raising rates, they keep raising rates until something breaks. And I don't think that's going to be, I think that's going to apply here too. I don't know if we'll get to 4% on the terminal rate before all is said and done. And unfortunately, because there might be some breakage of enough things that it might force the Fed to abandon that aggressive policy. Now, let me be clear on something about breakage. You could argue we've already broken quite a few things as well. We have already got a 20% correction in the S&P. We got a 30% correction in the NASDAQ, and the total return for the bond market is the worst ever recorded. And some of the data goes back 200 years. And this is the worst year for the bond market in 200 years for some data as well in the bond market. So haven't we broken enough things? We go back to the true game changer here is inflation. We are now in the highest inflation rate in 40 years. What needs to break is inflation. We need to see a break of inflation lower. So when the Fed is given two options, high inflation, potentially causing a recession, otherwise known as stagflation, I've been arguing that the Fed is going to err on the side of being more aggressive to get inflation down. They had a card to play, let's be too dovish. They did that last year. They used the word transitory. They didn't do anything when inflation started the year in 21 at 1.4% and ended the year at 7.5%. They can't do that again. The president of the United States 2 weeks ago had Jay Powell in the Oval Office and ordered him to bring inflation down. They have no choice but to be aggressive to bring inflation down. So if the markets are on their knees, if the economy's on their knees, and inflation isn't, unfortunately, I don't see the Fed backing off until they break inflation. So rates go up until something breaks. What is that something that will break? It will have to be signs that inflation is definitely peaked and rapidly decelerating. We just got a terrible CPI report on Friday, the week before we record here. And the day we're recording, we're making yet another new high in the national average of gasoline prices. So we've got no evidence at all that inflation is breaking, at least not yet. So I think in lieu of that, rates keep going up and the heat keeps staying on. And unfortunately, that's going to be tough for risk markets.
Absolutely. I'm going to stay on the topic of breakage, if you don't mind. It's not going to be necessarily about inflation. And I'm curious, as the Fed raises rates here, I mean, globally, we've seen one of the biggest mark-to-market moves that I think we've seen in the history of markets, not just the U.S. market, but globally across asset classes. I'm curious what keeps you up at night? The hidden risks in the marketplace. We've seen these big moves in public markets. What's number one on your mind for the biggest risk here, aside from obviously inflation?
Yeah, well, I'd have to say that number one, the biggest risk is inflation, and put it in terms of risk terms. The amount of people that until Friday that were still, this is nothing. It's going to go away. Deflation is the biggest worry. Inflation will all, settle out in 23, 24, 2% for the rest of our life. And we were still saying that Friday before the CPI report, that to come to this recognition that there has been a secular change. And as I said earlier, it's not surprising that these things happen in the wake of a pandemic, because every pandemic seems to produce something like this, not necessarily inflation, but some major secular shift. Work from home is it, and that's going to movies is the other one too. I think that, we're only back to 60% of people going back to movies that they did pre-pandemic. Everybody now likes TV shows on their big TVs in their house, and movie theaters are in a world of hurt as well too. But then after that, I think you're right that the financial markets have been hit so bad with the biggest sell-off ever in the bond market, 20% down in 6 months in the stock market, that there are some hidden or not understood risks that are out there. I can't quantify them. You can't quantify them. We never really know where they are. But there is a lot of stress points in the financial system right now because of these moves in financial markets. And as they continue to be under pressure, markets continue to fall, both the stock and bond markets, those pressures continue to grow. And we could potentially see problems percolate to the surface. And that is a real worry. Now, as we're recording, we're starting to see that in a big way in the crypto markets. We've had the failure of big important protocols. We had the failure of a centralized exchange. Literally the day we're talking, Celsius closed its doors. And so we're starting to see that the crypto markets are in a world of hurt that no one really anticipated. I don't think that the traditional financial markets are that far away from it right now. And the problem with the traditional financial markets is it's impossible to really understand where those problems are. Quick example is 2008. Alan Schwartz, who was the CEO of Bear Stearns, was absolutely correct on Wednesday that his firm was fine and there was no problem with Bear Stearns. And on Monday, they filed for bankruptcy and were liquidating. In 5 days, they went from everything was fine to liquidation. We saw that with Lehman Brothers. We almost saw that with Robinhood a year ago as well, too, or about 18 months ago. So it is one of these things where everybody's fine, everybody's fine, everybody's fine. Now we're not. That's kind of the way that the financial system works. And yes, everybody's fine today, but that pressure is percolating as markets go. And my fear is someday, if it gets bad enough, and it isn't now, but if it gets bad enough, there might be a moment where, okay, we're not fine.
Interesting. Yeah. No, look, I mean, there are a lot of unknowns out there. And when you do see mark-to-market moves like this, like you said, one day you're fine and one day you're not fine. Certainly an unprecedented period of volatility. Jim, very insightful across the board. Like I said, you've had a great call on inflation. It has been all about inflation. We appreciate your time today very, very much. And Michael, I'm going to turn it back to you if you don't mind.
Yeah, Jim, thank you so much for your valuable insights. One of the things Greg and I always are committed here is talking the truth, and whether they're tough conversations that our clients and people need to hear, we want to express that to them. So we appreciate that. I guess my closing question will be, and Jim, you touched on it a little bit on some of the percentages. Greg, you sticking with 50?
I am. Yes, I think the as Jim said, the forward guidance has been so strong, 50 and 50. I think the second 50 will probably take off the table. But I think if the Fed goes 75 here, they set a different cadence. The market's already grabbing a world of its own. So yes, I'm going to stick with 50 for this week.
I love this. This was great. I think we could have sat here for an hour actually today because I had so many follow-up questions in my head. But like I said, I'm going to let the guys who know best speak. So, Jim, we are so grateful to you. We'd love to have you back anytime. Greg, you know what this means to me 3 years later, you and I doing. So everyone remain safe, have a wonderful week, and try to keep sanity amongst maybe what we'll see a little insanity. So everyone have a great day. Thank you.